Warren Buffett has long relied on Charlie Munger, who is currently the vice chairman of Berkshire Hathaway, as a business partner. Many people might not be aware of the fact that he has a net worth of $2.3 billion and is a successful investor in his own right. In addition to stressing the need of timing your investments, Charlie Munger is well cognizant that things will only get worse from here. What is Charlie's investing advice for investors to take advantage of the upcoming stock market crash and global recession when high inflation and rising stake rates strike the global financial markets in 2023? Charlie Munger is without a doubt one of the names that are held in the highest regard in the world in the value of investing. He has been Buffett's trusty right-hand man for decades and is still a vice chairman of Berkshire Hathaway at the ripe old age of 99. He is also a very successful investor, though, with a net worth of $2.3 billion, as many of you are surely aware. A large part of his investment success can be attributed to the use of reasoning. Over the years that he has been doing it, it has greatly benefited us. The market is currently predicted to fall by 20% inflation, and it's still forecasted to be high, and in 2023, interest rates are expected to increase further. Because it appears we will be investing in a bear market this year, it will likely be the biggest investment challenge we encounter in 2023. 2022 saw a 20% decline in the S&P 500 as interest rates were increased to 4.5%. Yet, given that the Fed reiterated its objective of lowering inflation back down to 2%, it appears that interest rates will continue to rise in 2023. The first concern is whether or not we should spend now, given that all of our assets have lost 20% since around 2022. It is worthwhile considering the potential for future adversity. According to Charlie, the economy may occasionally go through boom and bust periods, but you still need to experience both, since we all may need to keep moving forward regardless of whether the tide is in our favor or not. Even while the economy may occasionally act in your favor or against you, long-term investors don't worry if prices decline sharply in the near future. Even though these times make us feel terrible, it's best to take advantage of them and see them as a long-term chance rather than trying to time the market precisely. In a 2008 interview, Charlie was asked about this level of concern with Berkshire Hathaway's stock price drops. Charlie replied, "Zero. This is the third time Warren and I have watched our holdings in Berkshire decrease by 50% from top to bottom. I think it's the nature of long-term shareholding with the normal vicissitudes and worldly outcomes, and in markets, the long-term holder has his quoted value of his stock go down by, say, 50%. The speaker continued. In reality, Charlie suggested that someone is unfit to be a common shareholder and deserves the subpar outcomes they would ultimately receive if they are unable to react coolly to a market price drop of 50% 2 or 3 times in a century. And the reason for this is that the cornerstone of sound value investment is finding good firms and holding them for a very long period. In reality, the majority of stock market fortunes are created in this manner. There is no waiting for the right time to act, and there is no guessing. Simply said, one can choose to invest in high-quality companies, stick with them through both good and bad times, and then take advantage of downturns as opportunities to make long-term purchases. But in order to do so, a person must have exceptionally high emotional intelligence and train themselves to the point where they don't care if the stock market is increasing or collapsing. The best way to do this is to become very familiar with your plan, thus your conscious or your objectives and the procedures required to achieve them. Also, you need to carefully consider your capacity to commit to a long-term strategy and the businesses you have purchased. Charlie's odd disregard for the status of the market was evident when he said, "Even though I constantly invest in American stocks, my shares of Berkshire Hathaway have dropped by 50% 3 times. I don't really care about it. If you have my attitude, it doesn't really matter." The line "Success and Failure" from Kipling's poem If has always been a favorite of mine. Given each of those two imposters the same treatment, you merely concede it. It might occasionally work for you and occasionally work against you. The entire world is a single game. Munger's approach is to just ride the wave, make long-term good decisions, and profit from market drops. And the next time someone tries to convince you to stay away from the stock market, invest in a flashy new cryptocurrency or concentrate on the coming year, because that is when you will make money. Just remember Charlie's response to the question, "Are you old-school Ben Graham valuation techniques?" He responded, "An investment entails receiving more value than you paid for. To be successful, you need to get more for your money. There is now a sizable segment of people who don't even understand what they are purchasing. The quotes on the ticker are all that they are. Think about past wild booms and how well they played out. The bubbles of the South Seas, the late 20s, and so forth. Since the beginning of capitalism, this has been a reality. Crazy bubbles have existed. In essence, you only need to have faith in the procedure. There will always be value investment. In circumstances like the ones we're currently experiencing, we make long-term plans, look for high-quality enterprises, and buy them. But before we get too into it, let's take a look at the current situation because rising interest rates will probably cause stocks to fall again in 2023. Also, we must contend with rising inflation. So, in a situation like this, what is Charlie's guidance for putting value investing concepts into practice? What will happen in the end, and apart from buying high-quality equities, what other advice does Charlie have for individual investors to better manage the side effects of inflation? He stated, "You might also have to choose the finest choice from a number of undesirable options. This is typically a method of decision-making. Also, the Mungers hold a number of apartment complexes, Costco stock, Chinese stocks through Lilu, a tiny portion of Daily Journal stock, and Berkshire stock." Charlie, do you think this is perfect? No. Does he consider it acceptable? Yes. The Munger's most crucial lesson is that diversification is not necessary. Charlie said, "If you get 4 good things, count yourself lucky. You should consider yourself fortunate if you have 4 things to purchase if your goal is to do better than average. A $20 request is equivalent to asking for an egg in your drink. Few individuals possess the brain power necessary to make 20 wise investments." Also, the market might be full or against you at any time, as Charlie previously said, and you could have to decide on the course of action that won't harm you the most. Being in that situation at a time when rates are raising and inflation is skyrocketing would be difficult for any investment. It's improbable that this year's returns will be on par with those of 2021, with rates already at 4.5% and climbing. Charlie, though, points out that the Munger's lesson is simply to invest in top-notch assets and remain with them. Is Charlie's resume perfect? No. Is it sufficient? Yes. It's not always necessary to aim for 20% annual returns. You choose the items you want to buy, wait to see when they go on sale, and then buy them once they do. Keeping in mind that the majority of value investing is really simple of watching and waiting. You don't need to stress about the macroeconomic climate or your weekly shopping list. Charlie and Warren think that 1 or 2 opportunities each year are plenty, and most of the time it's humans who complicate things too much. They struggle with FOMO, or the fear of missing out, and they make an effort to take advantage of every opportunity. They're the ones who cause difficulty for themselves. We therefore require a solid strategy in these circumstances, emotional restraint, and the understanding that we cannot always get our way. What types of firms, then, should we be keeping an eye on during these difficult times? Charlie said in response, "We are looking to acquire a truly solid business at its core. In other words, it could be operated by a total moron and still function properly. Then, we want a terrific individual to run that company, which even a fool could manage well. And even if we have a fantastic company that is headed by a fantastic person, it really turns on us to do a terrific job. We support businesses that endure a great deal of subpar management and nonetheless prosper. A corporation can continue to be resilient if it's strong enough." According to Warren, when a company with a reputation for being difficult and a management with a possibility to be outstanding combine their efforts, the business's reputation remains. If they are harsh to begin with, they remain such. The most crucial lesson to learn from investing is this kind of setting or environment is undoubtedly Charlie's suggestion. Strong companies that can survive difficult times are what you desire. Now, what does this actually mean? It means that the company has an inherent competitive advantage over its rivals, that it is not overly dependent on debt, that it has not extended itself with loans, and that it could bring the business to its knees, that its business model is successful, and that it generates profits regardless of the state of the economy. Last but not least, it also denotes simplicity. You want a company that an idiot could run and could still be fine because, as Charlie pointed out, if you were a genuinely long-term shareholder, an idiot would probably lead that company at some point. Overall, it will surely be challenging, but if you can manage your emotions, make investments with long-term perspective, wait patiently for opportunities, and keep things simple, you'll be well positioned to thrive in 10 years.